Are you tired of getting stopped out of trades prematurely? If so, the average true range (ATR) indicator may be just what you need to manage risk and avoid losses in volatile markets. In this video, we'll take an in-depth look at the ATR and explore how it can help you become a more successful trader. We'll start by discussing what the ATR is and how it works, then we'll show you how to plot the ATR on charts and basic concepts about ATR. From there, we'll dive into how you can use the ATR to set stop losses and profit targets, and we'll also cover advanced version of this indicator. Finally, we'll share some tips and best practices for using the ATR effectively. So what is ATR and how does it work? Average True Range (ATR) is a technical analysis tool introduced by J. Wells Wilder Jr. to provide traders with an understanding of how much an asset's price typically moves over a given period of time. Instead of delving into the technical details of how to calculate the ATR, our focus will be on the practical aspects of using the ATR in trading. However, here's a short brief on how the ATR is calculated. The average true range is a measure of an asset's volatility and is determined by taking the greatest of three values. Firstly, it is the difference between the current high and the current low of a trading period. Secondly, it is the absolute value of the difference between the previous close and the current high of a trading period. Finally, it is the absolute value of the difference between the previous close and the current low of a trading period. Alright, let's move on how to add the ATR indicator to your charts. To plot the average true range (ATR) on a chart, you'll first need to have access to a trading platform that offers technical analysis tools. Most platforms will have the ATR indicator available, but if you're not sure where to find it, you can try searching for it in the indicators section of the platform. Once you've found the ATR indicator, you can typically add it to your chart by simply clicking on it onto the chart. You can customize the period over which you want to calculate the ATR in the indicator's settings. The default period is usually 14, but you can adjust this to fit your trading style and the time frame you are analyzing. It's important to note that the ATR is a lagging indicator, meaning it is based on past price action, so selecting the right period is important for accurately reflecting the current market conditions. Look at this corner. This is the value of ATR at this trading period. A higher ATR value indicates higher volatility, with the asset experiencing larger price movements. On the other hand, a lower ATR value suggests lower volatility and smaller price movements. Okay, let's move to the chart. This is chart of Apple in 5-minute time frame. Look at this area. How a bunch of small candles forming during this period. Then look at here. Notice how ATR is almost flat during this period, which indicates lower volatility. In opposite, take a look at this period of time. How a bunch of large candles appears during this period and price making larger movements during this period while ATR is increasing. This indicates periods of high volatility. Always keep in mind that ATR is a volatility indicator. It does not show the direction of trend. Let's move to the chart and grasp this concept. This is chart of Tesla in 5-minute time frame. Here, we can observe a scenario where the price of a stock is increasing, but the ATR values are sloping downward. In another instance, we can see that the ATR values are increasing, while the price is going down. These examples highlight the fact that the ATR measures the volatility of the market, rather than its direction. Now, let's delve into the most interesting and useful aspect of this topic: how you can use the ATR to effectively manage your stop losses. I am sure you got experience of this. You did your analysis and enter on a trade. It hit your stop loss and then moved towards your predicted direction. This is a bit irritating. In this situation, this indicator can help you to get rid of this problem. Let's move on to the chart to understand the strategy. This is a chart of Alphabet in a 5-minute time frame, and it shows a clear uptrend. The price is approaching a key level and then makes a pullback. We then see a doji, which shows indecision between buyers and sellers during this period. After that, we get a bullish momentum candle, indicating trend continuation. You enter the trend on the formation of the bullish momentum candle and place your stop loss at the swing low, which is around 102.25 price level. Then, you wait to see what happens. The price moves upward to the level where it was previously rejected and gets a rejection, moving downward and hitting your stop loss. Then, it moves towards your predicted direction, which is upward. So, how can you solve this problem? Let's look at the ATR value on the candle you entered for a trade. It is around 0.33. Now subtract this value from your original stop loss, which is at 102.25, and you place your stop loss at the level of 101.92 price level. Notice how the price drops to the level of 102.05 level and moves upward, saving your stop loss. Now, let's see another example. This is the chart of Reliance in a 5-minute time frame. The price is moving towards a key level, and we get a long wick candle as well as a bearish engulfing pattern. You place your stop loss at the recent swing high, which is around the 2,422 level. Look at what happened next. The price moved a little bit down and then went upward, hitting your stop loss before moving downward, which is your predicted direction. If you had used ATR to set the stop loss, you could have saved your stop loss. Look at the value of ATR on the entry candle, it's around 3.60, and your stop loss is at the 2,422 level. Just add these numbers, and your new stop loss using ATR is at the 2,425.60 level. Notice how the price moved up to the 2,424.70 level and then moved downward. Like this, you can prevent yourself from getting stopped out of many trades using ATR. Before moving ahead, if you like this video and want us to make more contents like this, subscribe to us and hit the like button. Make sure you comment below the topics you want to cover in our upcoming videos. Moving to the next, let's see how ATR used to set target profit. Let's move to the chart and see it. This is the chart of Bitcoin in 5-minute time frame. Suppose you enter on this candle. At this point of time, the value of the Bitcoin is around 28350 and the value of ATR is almost 50. Although we use ATR to set targets in various methods. But most used method is to take profit 3 times of the value of ATR. So here the take profit will be around 150. Add this number to the value of Bitcoin price and your take profit level is around 28500. Note, don't take the take profit price as a price point rather than take it as a zone. That means you draw a zone on the chart at this level to book your profit. If you further notice that your take profit zone is at a swing high, which gives another confluence to make it a profit booking zone. Further, notice how a long rejection candle forms when price approaches to this area, which indicates to book your profit. Let's see an example in downtrend. This is the chart of Microsoft in 5-minute time frame. At the time of your entry, which is on this candle, the price is around 280. And the value of ATR is 0.76. So the take profit ATR value, which is 3 times of the ATR value, is at 2.28. Subtract this number from the stock price and your take profit price is around 277.72. As we said before, don't treat it like a single price. Draw a zone. Notice at this area, which showing a small pullback before and a small period of consolidation is also visible, which gives additional confirmation to set this area as the take profit zone. Further, notice how candlesticks becoming smaller on approaching to this zone, which gives another indication to book the profit. Disclaimer: do the backtest of these concepts of at least for 3 months before entering to the trade, so that you can gain some experience about market conditions and how to use these concepts in different market conditions. Let's move to the next chapter, that is an advanced version of ATR. In the traditional version of ATR, the line is not quite useful to place stop loss. We will use an advanced version of this to place stop loss. Go to TradingView and search for ATR. And select this ATR stop loss finder by Verifid. It will draw lines on your chart. You can use these lines to place your stop loss and target level. You can customize the settings as per your trading strategy. The default period is 14, which means it calculates the ATR of last 14 candles. and the smoothing is basically the smoothness of the lines. We prefer to use EMA so that the lines moves with the real-time price. Next is the band multiplier, which means it's the width between the lines. We prefer to keep it at 1 so that the stop loss is placed at a small distance. Now look at this area if you place your orders at this candle, or this candle, or this candle, as it is a key area. You will be stopped out if you placed your stop loss below the swing lows. Instead, you place your stop loss below the ATR line and look, market goes up without hitting your stop loss. If you want us to make an in-depth video about this particular indicator, comment below. Moving to next, these are some tips and important points to use ATR indicator effectively. If you like this video, hit the like button. Subscribe us for more content like this.